Once upon a time, there was a great nation that believed money controlled everything. This nation had recorded two major blows in the pages of history: 1929 and 2008. In 1929, the stock market collapsed, as if falling into a pit, and within 3 years, stock values dropped by 89%. It took 25 years for the market to return to its 1929 level. After that dark period when unemployment reached 25%, banks failed one after another, and people's lifetime savings disappeared in an instant. Then came 2008. This time, the problem emerged through the real estate sector. The housing market collapsed, and the Great Recession began. Stocks lost 57% of their value in 18 months, unemployment rose to 10%, and banks needed bailout packages to avoid bankruptcy. Retirement funds suffered massive losses. It took 5 years for markets to recover. Now, the calendar shows 2025, and a completely different period appears, a far more dangerous continuation of the previous story. This time, there is not just one bubble. Stocks, bonds, and real estate prices have all risen excessively at the same time. Historians call this the everything bubble. And the darkest statement of the story is this: if everything doesn't collapse at once, there will be nowhere to hide. So what if the period we are living in is not actually a new one? Perhaps in 2025, we are not truly here, but in the context of history, we are in 1928, the silent, misleading moment of calm before the Great Depression. But is the situation worse this time? Because the magical methods that saved the system in 1929 and 2008 are no longer effective. The central bank cannot cut interest rates to zero because they are already very low. It cannot print unlimited amounts of money because it already has, leading to the highest inflation in 30 years. The government cannot borrow enough to save everyone because it is already crushed under a $36 trillion debt. Now, let's see why all major financial indicators are flashing red, why the collapse is likely to occur between November 2025 and June 2026, and why the upcoming crash will create the most unprecedented wealth destruction in history. This is not a prediction. It is a calculation. To understand why this period is different from previous collapses, one must realize that there is not just one bubble, but 3 different bubbles occurring simultaneously, something never before observed in history. The first bubble is in the world of stocks. The S&P 500 is currently trading at around a price-to-earnings ratio of 28, nearly double the historical average of 15 to 17. Such overvaluation has been observed only twice, in 1929, right before the Great Depression, and in 2000, before the dot-com crash, when the Nasdaq fell by 78%. In both periods, the market collapsed shortly after reaching these high levels, but the real danger in 2025 is something called concentration. The 7 major firms, Apple, Microsoft, Nvidia, Amazon, Google, Alphabet, Meta, and Tesla, make up roughly 30% of the total market value of the S&P 500. Meaning, if these 7 firms fall, the whole market trembles with them. A structure where so few companies carry such a massive weight had not been seen since the fragile market of 1929, dependent on a few industrial stocks. In 2000, the tech bubble was huge, but it did not cover this much of the total market. Today's concentration is more extreme, more dangerous, and more fragile. Nvidia appears to be the sole symbol of this madness. Its price-to-earnings ratio is above 65, meaning investors are willing to pay $65 for every $1 of earnings. The company's market value has surpassed $3 trillion, becoming larger than the entire stock market value of Germany, the world's 4th largest economy. This is not a rational valuation, it is speculation fueled by AI expectations. In 1999, everyone believed the internet would change everything. They were right in the long term, but terribly wrong in the short term about stock valuations. Today, we are living the new chapter of the same story, this time involving AI. The second bubble has emerged in real estate. This bubble is larger than the housing bubble that affected the global financial system in 2008. As of November 2025, home prices are about 50% above their long-term average relative to income and rent levels. In 2008, at the peak, This rate was 35%, meaning the current housing bubble is 43% bigger than the one that caused the Great Recession. The 2008 crisis led to trillions of dollars in bailouts and severely damaged capitalism. That bubble involved a 35% overvaluation. Now we are at 50%. Most people don't even realize this is a bubble because after being exposed to high prices for so long, they have accepted it as normal. But housing is only one side of the story. In commercial real estate, a slow and silent collapse is happening, one that will accelerate in 2025 and 2026. About 45% of office buildings in the U.S. are unused. Remote work has turned these structures into ghost towers. The office vacancy rate in San Francisco is around 35%. Many of these buildings were financed with loans taken when interest rates were around 3%. Now, those loans must be refinanced at 7 to 9%. These buildings cannot generate enough cash flow, even as their financing costs have tripled. This leads to defaults, which means bank losses. The same collapse seen in 2008 with subprime loans may now occur in commercial real estate. The third bubble is what makes 2025 unique and more dangerous: bonds. Government bonds are classically considered the safe haven. When stocks fall, they are the escape route. In 1929, when stocks fell 89%, bonds remained safe. In 2008, when stocks fell, investors fled to treasury bonds, and bonds increased in value. In 2025, both stocks and bonds are falling because the U.S. government is so indebted that the bond market can no longer carry it. Total federal debt has surpassed $36 trillion. This equals about 125% of GDP. This level resembles the immediate post-World War II period. At that time, the U.S. stood as the only major economy not destroyed by war, and the world depended on it to grow again. But today, it competes with economies that have lower debt and stronger structures. Annual interest payments on the debt exceed $1.2 trillion, becoming the largest expense in the budget, bigger than defense spending and Social Security. Interest sits at the top of the national budget, like a shadow swallowing everything beneath it. When debt interest threatens everything, the government has three options: cut spending, causing contraction; raise taxes, causing recession; or print money to pay the debt, causing inflation. All three options lead to crisis. None offer a peaceful harbor. When interest payments alone equal Mexico's entire GDP, no good solution remains. This is why it is called the everything bubble. Stocks are extremely overvalued. Real estate is even more inflated than before the 2008 crisis. And bonds, traditionally the safe haven, are now crushed under an unsustainable debt load. The similarities between 1929 and 2025 are so clear that it feels like history is being replayed. In 1929, the Dow Jones price-to-earnings ratio reached 33, an unprecedented extreme. In 2025, the S&P 500 is trading at around 28 times earnings. In 1929, society believed new technologies, electricity, radio, automobiles were creating a permanent economy, and that old valuation rules no longer applied. Everyone thought, this time is different. In 2025, AI takes on that role. It is treated as if the old rules no longer matter. In 1929, the stock market was flooded with margin debt. From doctors to shoe shiners, everyone was buying stocks with borrowed money. Stories of overnight wealth spread rapidly. In 2025, margin debt relative to GDP has reached similar levels. But leverage is no longer limited to traditional margin accounts. There has been a huge rise in options trading among retail investors. People are buying stocks with credit cards, and companies are borrowing money to buy back their own shares at inflated prices. Leverage is hidden in derivatives, options, and debt structures. Many participants don't even understand how these structures work. In 1929, the wealthiest 1% held roughly 25% of total income. The economy was built on the spending of a narrow wealthy group. When they reduced their spending, the system collapsed. In 2025, inequality is even worse. The richest 1% hold about 32% of total wealth. The top 10% make up 70% of consumer spending. When wealthy investors reduce their stock-based spending, consumer demand evaporates instantly, dragging the economy into collapse. But there is something that makes 2025 even more dangerous than 1929. In 1929, only about 10% of Americans owned stock. When the collapse came, 90% of the population was not directly hit by the stock crash. They were affected later by unemployment and deflation. In 2025, about 58% of American households own stocks directly or through retirement accounts, 401k IRA. When the market collapses, more than half the nation sees its retirement savings wiped out instantly. This time there is no shield, no division. Everyone is affected simultaneously. In 1929, the banking system consisted of many small banks, none insured by the federal government. When the crash occurred and people rushed to withdraw their money, banks failed. When banks failed, workers' lifetime savings disappeared. In 2025, FDIC insurance theoretically guarantees deposits up to $250,000. But FDIC has only about $125 billion in its fund, while insured deposits total nearly $10 trillion. If several large banks collapse at once, the insurance fund will be insufficient. To protect depositors, the government would need to print trillions, devaluing the currency through inflation. In the end, depositors lose either through bank failures or inflation. There is no third option. In 1929, the Federal Reserve was relatively young and still had some credibility. It could cut interest rates more boldly, though it reacted too slowly. By 2025, the Federal Reserve has repeatedly proven over the past 15 years that it cannot effectively manage the economy. After 2008, quantitative easing created a massive bubble. Low rates were sustained for too long, and the everything bubble was produced. Then, in 2022 and 2023, rates were raised aggressively to fight inflation, pushing the economy to the brink of collapse. The Fed's credibility is weakened, and its tools are nearly exhausted. The 2008 financial crisis was like a preview of a larger danger. The problem back then was high-risk mortgage loans given to people who could not pay them back. These loans were packaged into complex financial instruments and sold globally. When housing prices stopped rising and began to fall, people could no longer refinance, and defaults surged. These defaults revealed how flimsy the foundations were for the banks holding these instruments and operating with 30-to-1 leverage. Lehman Brothers held $30 of assets for each $1 of capital, and when those assets fell just 3% in value, it was pushed into bankruptcy. The greatest panic of 2008 followed. In 2025, the term subprime is not used much, but the same logic still applies. High-interest 84-month auto loans are offered to people who can barely afford them. Credit card debt has reached record highs. Average balances are about $6,800, with interest rates between 21% and 28%. Total credit card debt exceeds $1.14 trillion. Delinquencies have reached levels not seen since 2011. This matters because consumer spending makes up about 68% of the U.S. economy. Consumers are staying afloat through debt, but they have reached their limit. Since they cannot borrow more, they must cut spending, harming the economy. The situation is not much different for student loans. Payments, paused in 2020 during the pandemic, resumed in October 2023, and delinquencies are rising. Total student loan debt is around $1.77 trillion, burdening 43 million borrowers. Many young people feel crushed under a debt they may never be able to repay in their lifetime. This shifts hundreds of billions of dollars each year away from the economy into debt repayment. Instead of buying homes, starting families, or consuming, young people must live under the weight of this burden. The generation expected to drive economic growth is trapped under low-return debt. During the slow commercial real estate crisis, more than $2 trillion in commercial mortgages will come due between 2025 and 2026. Most of these loans were taken when interest rates were around 3%. Now, refinancing rates are between 7% and 9%. Buildings financed with 3% interest now become unprofitable at 8%. Property values in many markets have fallen by 40% to 60% because buyers know these buildings cannot service their debt at current interest levels. When owners cannot renew their loans, they will have to hand their keys over to the banks. As regional banks add these real losses to their balance sheets, their capital will evaporate and they will face closure. In fact, the trailer of this movie was released in 2023. In March 2023, Silicon Valley Bank collapsed, becoming the second largest bank failure in U.S. history. That same week, Signature Bank failed. In May 2023, First Republic Bank collapsed, and the massive loss was absorbed by the FDIC and transferred to J.P. Morgan. In January 2024, New York Community Bank came under stress. All of this happened before the recession began. Once the real recession starts and default rates rise, many regional banks may face a similar fate. The FDIC's $125 billion reserve could be depleted within weeks. Printing new money to save the rest would follow devaluing the currency over time. Another factor increasing market fragility is the extreme dependence on the Magnificent Seven. These seven stocks make up 30% of the S&P 500's value. Nvidia alone, with a price-to-earnings ratio above 65, makes up about 7% of the index. If Nvidia's earnings fail to meet expectations or belief in AI weakens, its stock could easily fall by 50 to 70%. That single move could pull the index down by 3 to 5%, triggering psychological effects and dragging down other major companies. Meanwhile, insiders have begun to exit quietly. Company leaders are the first to see issues in finances, order flow, and structural weaknesses. If they begin selling their shares in large quantities, it means they themselves no longer believe in the valuations. In 2024 to 2025, Jeff Bezos sold more than $13 billion of Amazon shares. Mark Zuckerberg sold billions of dollars worth of Meta shares. Nvidia executives sold shares even as the stock reached record highs. This happened in 1929 and 2000 as well. Insiders walk away quietly when they realize the market is overvalued. At the same time, one of the most renowned investors in history, Warren Buffett, is holding more cash than ever. Berkshire Hathaway's cash pile has surpassed $325 billion, both the highest absolute amount and the highest relative proportion in the company's history. Buffett has reduced major holdings like Apple and moved to safer investments. When asked why, he stated that valuations had risen too much and he could not find a reasonable investment opportunity. His Buffett indicator, the ratio of total market value to GDP, is at 185%. Buffett considers anything above 120% to be dangerous. 185% is an alarm bell. If the world's most cautious investor prefers to hold cash, it is unlikely to be a coincidence. Unemployment has begun to rise. At the beginning of 2023, unemployment was 3.4%. By October 2025, it rose to 4.1%. While 4.1% is historically low, economists know that the trend matters. Claudia Samm's Samm rule states that when the 3-month unemployment average rises 0.5 points above its lowest point in the last 12 months, the economy is entering a recession. This rule has correctly signaled every recession since 1970. We are approaching this level. Once unemployment begins rising, it tends to rise sharply. Delinquencies on auto loans have reached levels unseen since the 2008 financial crisis. About 7.5% are 90-plus days overdue. Average monthly payments for new car loans exceed $740, and loan terms extend up to 84 months. This indicates a new form of subprime credit, even if the term is not used. People are buying vehicles they cannot afford, and when they fall behind, it is not only banks that lose. People lose their transportation and, often, their jobs. Student loan delinquencies are also rising rapidly after payments resumed. With 43 million people carrying $1.77 trillion in student loans, many must postpone home purchases, family plans, and consumption. The generation expected to drive growth is drowning in debt. The rest of the world is not doing well either. Wars and geopolitical tensions have become everyday events. The conflict in Ukraine, ongoing conflicts in the Middle East, the possibility of Chinese action toward Taiwan, and fragmentation of trade blocs all threaten energy supply, food availability, and critical supply chains. This raises the specter of 1970s-style stagflation, inflation combined with stagnation. Markets hate uncertainty. The uncertainty surrounding 2025 is the highest seen since the 1970s. Even major players in commercial real estate are shifting toward handing over the keys. Brookfield Asset Management struggled with loan repayments on 2 Los Angeles office towers in 2024. Blackstone, the world's largest commercial property owner, is dealing with increasing redemption requests from investors. If even the so-called smartest money is abandoning properties, the meaning is clear. With these interest rates and vacancy levels, the numbers simply don't work. As each new loan comes due in 2025 to 2026, the impact will grow. More defaults, more bank losses, more bankruptcies. A collapse does not need a massive explosion. Perhaps only one trigger is enough. A disappointing earnings report from a member of the Magnificent Seven, the failure of a large regional bank, a geopolitical escalation, or a debt ceiling confrontation. The specific spark doesn't matter. The system is so fragile that any significant shock can knock down the dominoes. What matters is that once one domino falls, the others follow. If Nvidia or another major company fails to meet expectations, algorithmic trading systems react in milliseconds. Stock prices can fall 10 to 15% in a single day. Because Nvidia makes up 7% of the index, this alone could drop the S&P 500 by around 0.7%. But the real damage lies in the breaking of the underlying narrative. If belief in AI weakens, investors will question the valuations of Microsoft, Apple, Amazon, Google, Meta, and Tesla. Within days, these 7 stocks could fall 20 to 30%, dragging the index down 6 to 9%. Then come margin calls. Investors who bought stocks with borrowed money see their collateral fall in value. Brokers demand more cash. Those who cannot pay are forced to sell. Forced selling pushes prices lower, triggering more margin calls. In 1929, this mechanism created an unstoppable collapse. In 2025, with margin debt at similar levels, the process is ready to begin again. At the same time, institutional investors managing trillions will activate their risk management systems. Pension funds, university endowments, and sovereign wealth funds automatically sell when certain thresholds are breached. No emotion, no panic, just rule-based selling. When stocks fall 20%, some must sell. This deepens the collapse. In the first month, the market could fall 30 to 40%, as retail panic selling, margin calls, and institutional de-risking reinforce each other. Even those seeking safety in bonds may not find refuge. In 2025, the Treasury must sell trillions in new bonds to cover massive deficits and refinance maturing debt. If investors flee to bonds for safety, while the government is trying to issue huge amounts of new bonds, interest rates could rise even further. This creates a doom loop. Higher interest rates increase debt service costs. Higher costs force more borrowing. More borrowing requires more bond issuance. Increased issuance pushes rates even higher. At the end of this cycle lies default, or the slow erosion of the currency through inflation. The housing market will freeze as buyers pull back, and sellers refuse low offers. Listings sit for months. Offers drop. Those who must move or need cash will be forced to cut prices. Falling prices become the new reference point and drag down the value of nearby homes. Within 6 months, prices could fall 20 to 30% from their peak. Within a year, declines of 40 to 50% could occur in overvalued areas such as Austin, Phoenix, Boise, California, and Florida. Those who bought homes at high prices in the past 3 years may wake up one day owing more than their homes are worth. In commercial real estate, defaults increase. Owners unable to refinance stop payments and hand keys to banks. Banks must take buildings worth 40 to 60% less than their loan amounts onto their balance sheets. This causes huge losses. Banks with eroded capital fall below regulatory thresholds and face closure. Between 2008 and 2013, 465 banks failed. This time, a similar or larger number may fail in a much shorter period. When bank failures begin, even healthy banks are affected by panic. Once people see a few bank failures in the news, they think, "What if my bank fails too?" Ordinary people cannot distinguish between strong and weak banks. Thus, everyone assumes the worst. This is the classic bank run. As deposits shrink, banks must sell assets to raise cash. Fire sales drive prices down, increasing losses, pushing even strong banks toward danger. FDIC intervenes, saying, Deposits are safe, but its fund is limited. After a few large failures, the $125 billion fund is drained, leaving only money printing as the solution. Deposits may be protected nominally, but inflation erodes their purchasing power. As the economy contracts, unemployment rises. Companies with declining revenue cut workers. Big tech firms lay off 10 to 20% of their workforce. Financial firms shrink. Businesses dependent on consumer spending close as customers can no longer spend. 3 months into the collapse, unemployment may jump from 4% to 7 to 8%. Within 6 months to 10%, and within a year to 12 to 15%. The Federal Reserve appears trapped between two options. One option is cutting interest rates and printing money to stabilize markets. Yet this risks reigniting inflation. Inflation reached 9% between 2021 and 2023, already crushing purchasing power. Printing trillions more could damage the dollar. The other option is doing nothing, allowing the collapse to run its course, leading to high unemployment and prolonged stagnation. What worked in 2008 may not work in 2025. For an American, the toughest moment begins when reviewing retirement savings. Seeing a $600,000 nest egg fall to $200,000 in a few months is more than a financial hit. It is a psychological blow. The thought, "I can finally retire," becomes, "I must work another 10 to 15 years." For those already retired and withdrawing from their portfolios, the situation is worse. Selling declining assets to pay bills locks in permanent losses. In 2008, retirement accounts lost value, but recovered after about 5.5 years. Those who were patient eventually bounced back, but there is no guarantee of such a recovery in the upcoming collapse. Japan's stock market crashed in 1990 and did not return to its peak until 2024. A generation that bought near the top never saw those levels again. A similar collapse in the U.S., combined with a long stagnation, could permanently erase a generation's wealth. Falling home values could trap millions of people in negative equity. Those wanting to sell discover they owe more than their home is worth, losing the freedom to move. The job market for new graduates could collapse. In 2026 and 2027, young people may struggle to find jobs or settle for much lower wages. Research shows that students graduating into the 2008 crisis earned lower lifetime income. With a larger crisis approaching, the impact could be deeper and more lasting. Small businesses are the most vulnerable heroes of this story. When consumer spending falls and credit tightens, neighborhood restaurants, small shops, and family businesses may close by the hundreds of thousands. Large corporations can shrink and survive, but small businesses, the heart of the economy, may disappear. What remains is a system dominated by giants, with less competition, less innovation, and less dynamism. As social safety systems struggle with rising demand, tax revenues fall. The government must stretch declining income to cover rising needs and eventually makes cuts. The most vulnerable, the elderly, disabled, and unemployed, receive less support just when they need it most. An economic crisis turns into a humanitarian one. As in the dark side stories of major crises throughout history, large economic collapses bring political turbulence. In the 1930s, Europe saw the rise of extremist movements. The hyperinflation of Weimar Germany paved the way for Hitler's rise to power. A country's democratic stability is never guaranteed. When people lose everything, they look for someone to blame and turn to those offering radical solutions. A collapse in 2025 could turn American politics unstable and unpredictable. For this reason, 2025 is like the combination of 1929 and 2008, the stock bubble of 1929, the debt and housing bubble of 2008, and today's massive government debt bubble are all present simultaneously. In 1929, only stocks collapsed, and only 10% of the public was directly affected. In 2008, the housing collapse forced the government to borrow and bail out banks. At that time, the debt-to-GDP ratio was around 67%, manageable. The Federal Reserve could cut rates from 5.25% to zero and expand its balance sheet from $800 billion to $4 trillion to support the system. In 2025, everything is fragile, and stretch to breaking point at the same time. If the Fed cuts rates to zero, inflation still not fully subdued could return. If it prints money, it could trigger even worse inflation than 2021 to 2023. The government cannot borrow more because its debt has reached 125% of GDP. Historical signals: an inverted yield curve, rising unemployment, increasing consumer debt, collapsing commercial real estate, rising insider selling, bank weakness, Buffett sitting on cash, all flash warnings. The yield curve inverted in July 2022 and stayed inverted for 27 months, returning to normal in September 2024. Historically, recessions begin 3 to 12 months after the curve normalizes, not while it is inverted. This means the danger window stretches from fall 2024 through late 2025. This story ends in one sentence: the collapse is at the door. This is not a prophecy. It is the logical result of a repeated pattern: debt mathematics, extreme valuations, and exhausted policy tools. The real question: when the storm comes, will you be among those caught unprepared, or among those who saw it coming and tried to protect themselves?